Hello everyone, welcome back to the channel. So you want to build real, long-lasting wealth, and you've heard that rental properties are among the best to help you do that. But maybe you're also thinking to yourself, I don't have time to be a full-time landlord, or the idea of having to handle toilets and tenants at 3 a.m. gives me the heebie-jeebies. Well, what if I told you that you could be building a portfolio of rental properties and have it be truly passive? That you could generate consistent cash flow without it becoming a second job? That's what we're breaking down today. We'll walk you through the exact strategies elite investors use to increase their wealth with minimal day-to-day effort. So, grab a notebook and let's get started. Now, the very first thing we need to get crystal clear is the difference between being an active investor and a passive one, because this is the foundation of everything. An active investor is your classic landlord. They're doing it all: finding the tenants, screening the tenants, collecting the rent, taking the maintenance calls. They get to keep 100% of the profits, but they also get to take on 100% of the risk and the massive time commitment. But a passive investor is more like a silent partner. They provide the capital, but they outsource all those day-to-day headaches to a professional property manager. Now sure, it costs you, typically in the range of 8 to 12% of the rent. But here's the mindset shift you need to have. That fee is not an expense necessarily. It's the direct cost you pay for the freedom of your time. You're effectively buying back your weekends and evenings, and you're buying a degree of legal protection. So the real question is, do you need to have a job as a property manager, or do you need to be an owner? Okay, so you want to be passive. The next big choice is what kind of rental you'll have. And this gets down to a choice between long-term and short-term rentals. Long-term rentals are your standard 12-month lease. They give you predictable, stable cash flow month in and month out. There is little tenant turnover, and operating expenses are usually much lower. This is the ideal scenario for a passive model. Vacation rentals, like Airbnbs, have a significantly higher gross income potential. But I did say potential. The reality is, they are a ton of work. You're constantly marketing, doing the cleaning between guests, stocking supplies, and dealing with a much higher volume of maintenance issues. To make this even semi-passive, you'd need to have a specialized and typically more expensive property manager, which can entirely eat up that higher income. So if true passivity is your goal, long-term residential rentals are, without a doubt, the default winning choice. Now, let's talk about the type of property itself. For most of us novices, we're going to be working with residential real estate. That's 4 units or less. Single-family houses, duplexes, triplexes. Those are great because they take less money to get into, and the financing is easier to get and more plentiful. Then there's commercial real estate. These are offices, retail outlets, warehouses, or big apartment complexes with 5 or more units. The entrance fee is greater, but the possible yields can be greater as well, and lease contracts are usually longer, which provides stability. However, and this is a big however, commercial property is more complicated to handle, and it's much more susceptible to economic highs and lows. Everybody requires somewhere to live, correct? The demand for housing is always there. So, for most passive investors, the path starts with residential properties, where the magic starts to happen. Leverage is quite possibly the best advantage of investing in real estate. So what is it? It's simply the use of borrowed money, a mortgage, to take control of a much larger asset. Let me show you. You make a 20% down payment on a property. That 20% down payment now has control over 100% of the asset. You get 100% of the appreciation, and you get 100% of the rent for putting down a fraction of the whole. This represents a 5x leverage multiplier on your money. It really amplifies your return. And as you build equity, you can even borrow from the equity to buy your next property, growing your portfolio ongoing without having to use your own money over and over again. Financing an investment property, though, is a little bit different than financing your own house. The lenders view it as riskier, so the rules are stricter. You need to be prepared for that. You'll typically need to put down 20 to 25%. Your credit score needs to be good, think 680, or even better, 720 and higher. Your debt-to-income ratio needs to be in good shape, typically 45% or lower. And this is a big one that is easily forgotten. You need to have cash reserves. Lenders typically require you to have 6 months of mortgage payments. That's principal, interest, taxes, and insurance, just sitting in an account. This is their way of knowing you can weather a vacancy without defaulting. And interest rates will be 0.5 to 0.75% higher than on a primary residence. So, get your financial house in order first. If that down payment sounds prohibitive, I have one word for you: house hacking. This is the ultimate cheat code to get into the game. House hacking is when you buy a multi-unit property, like a duplex or a triplex. You live in one of the units and you rent the others out. Why is it so powerful? Because now you can qualify for an owner-occupied loan. That means you can put down as little as 3.5% on an FHA loan versus 20 or 25%. The rental income from the other units will cover most, if not all, of your mortgage. So essentially, you're living for free or at a much reduced cost. You're building equity, and you're getting real-world experience as a landlord. It's the perfect training ground. Once you have a bit of experience under your belt, maybe through house hacking, you can transition to a strategy called BRRRR. That's short for buy, rehab, rent, refinance, and repeat. That's what you do. You buy a below-market value property that needs some work. You then rehab it, driving the value up with selective renovations. Next, you get a solid tenant to come in and rent it out, securing the income. Now you go back to the bank and refinance the property at its new, higher appraised value. Because it's worth more, you can generally pull out all or most of your original cash investment. And here's the best part: that cash you pull out is a loan, not taxable income. So you get your money back tax-free, and then you can repeat the process by buying your next property. It's a wealth-building machine. As you're browsing deals, you need a quick way of sorting out the losers. That's where the 1% rule comes into play. It's a back-of-the-napkin screening metric that's easy. It dictates that the gross monthly rent on a property should be at least 1% of the total all-in cost. That's the purchase price plus any necessary repairs that are immediate. So on a $200,000 house, you'd want to receive at least $2,000 a month in rent. If it's significantly lower than that, you can probably move on quickly. But, and this is a big but, this rule is just a starting point. It doesn't factor in property taxes, insurance, maintenance, and your mortgage. Never ever use it as your only foundation for an offer. In some high-dollar markets, this rule is nearly impossible to meet, but the properties are great investments because of appreciation. So if the 1% rule isn't enough, how do you properly value a property? Well, for income properties, the most important method is the income approach. This takes into account the net operating income the property generates. Basically, how much money is it actually generating after expenses but before the mortgage? The other two methods are the sales comparison method, which is just a matter of comparing what similar properties have recently sold for, and the cost method, which is what it would cost to replace the property from the ground up. There is also the gross rent multiplier, which is just a simple price to annual rent ratio. However, for a passive income investor, the income approach is your best friend. Now let's get practical and talk about the lifeblood of your investment, cash flow. This is where you figure out if a property is profitable or not. First, you have your gross cash flow. That's all your rental income plus any other fees minus an allowance for vacancy. Then you subtract from that all your operating expenses. That's repairs, property management, taxes, insurance. What's left is your net operating income, or NOI. It tells you how the property itself is performing before you even think about the mortgage. Then you subtract your mortgage payment. That's your debt service. And what's left in your pocket is your net cash flow. That's your actual spendable cash. A conservative rule of thumb, considered safe, is the 50% rule, which simply states that operating costs should eat up about half of your gross rent. If, therefore, your mortgage payment is more than what remains in the other half, you are in negative cash flow. Run this number carefully. To actually compare deals, you have to speak the language of returns. The two most important measures are cap rate and cash-on-cash return. Cap rate is an unlevered metric. You take the net operating income and divide it by the purchase price. It indicates the inherent return of the property itself, not taking into account any financing. It's great for comparing properties to each other within a market. Cash-on-cash return, or COC, is a levered metric. It's taking your cash flow for the year, so after your mortgage is paid, and it's dividing it by the amount of cash that you actually invested, like your down payment and your closing costs. That's telling you what kind of yield you're receiving personally on your money. So cap rate is going to be measuring the potential of the property, and cash on cash is going to be measuring your personal return with the power of leverage. You need to look at both. For long-term players, we have to get a little more advanced, since a simple ROI doesn't account for the timing of your money. That's where IRR and NPV come in. IRR, internal rate of return, gives you the true annualized growth rate of your investment over the entire period you hold it, taking into account your purchase, cash flows you receive, and final sale price. It's one of the best ways to rank different investment options. NPV, net present value, tells you what all those future cash flows are worth in today's dollars. If the NPV is positive, that means the investment will do better than your minimum acceptable return. These metrics give you a much more sophisticated overall picture of your investment's potential. Now, let's get back to the key to passivity, your property manager. Yes, they take 8 to 12% of your rent, but let's reframe that cost. An excellent manager provides 3 gigantic value propositions. Number 1, risk mitigation. They keep you in compliance with complex landlord-tenant laws, which can save you huge, life-altering fines. Number 2, operational efficiency. They have relationships with contractors and can get work done for 30 to 40% less than you could. And third, they save you a great deal of time and anxiety. They're your insulation against midnight phone calls. That management fee is not an expense. It's a strategic investment in your liberty and your peace of mind. Your property manager's most important single function is tenant screening. This is your number 1 safeguard against financial disaster. In fact, tenant damage constitutes about half of all landlord insurance claims. A good screening includes a comprehensive application, diligent adherence to fair housing laws, a decent credit report, verified income and employment, a background search, and here's the important one, verifying their rental history. Call their previous landlords. Seriously. And another professional tip, own your properties in an LLC. This holds your personal assets away from your business liabilities, which is essentially a fundamental, smart method of managing risk. In spite of good screening, from time to time, things do go awry. In the event that you must evict a tenant, you must follow the legal process to the letter. It always starts with a formal written notice. Then, if that doesn't work, you file with the courts to get a court-ordered eviction warrant. This whole process can take 30 to 45 days, or even longer. And I cannot stress this enough. Self-help evictions are 100% illegal. You cannot change the locks. You cannot shut off the utilities. You cannot throw their stuff on the lawn. Only a sheriff with a court order can rightfully evict a tenant. That's why that rigorous screening in advance is so important. Okay, now let's talk some tax strategy, since this is how you can make or lose a fortune. The IRS typically treats rental income as passive income. This sets up a trap, particularly for high-income individuals. Here's why. If your properties have a paper loss, frequently due to depreciation, those passive losses typically can only be used to offset other passive income. You typically can't use them to shelter the taxes on your W-2 job income. There is an escape hatch, referred to as real estate professional status, or REPS. Your rental losses can then be offset against your ordinary income if you qualify. But to qualify, you need to spend over 750 hours a year and more than half of your working hours materially participating in your real estate activity. This is in direct opposition. To be passive, you hire a manager. To reap the tax benefits, you have to be very active. So you have to choose. Do you want time freedom or maximum tax efficiency? You generally can't have both. Even as a passive investor, you still get amazing tax benefits. You get to deduct all your ordinary expenses, mortgage interest, property taxes, insurance, utilities, management fees, even mileage driving back and forth to the property. But the best tax deduction of all is depreciation. It's a non-cash deduction that enables you to write off the building itself over 27.5 years. So even when you're actually creating cash flow, depreciation can create a paper loss that shelters that income from taxation. You can even accelerate this with something called a cost segregation study, where you can write off portions of the building faster. It's an incredibly powerful wealth building strategy. And if you have to sell a property, you can postpone all your capital gains taxes. It's called a 1031 exchange. This allows you to sell a property and invest all of the proceeds in a new, like-kind investment property, postponing your tax bill far into the future. But the rules are very strict. You have 45 days to identify potential replacement properties and 180 days total to close on one of them. These deadlines are absolute, no exceptions. You also have to use a qualified intermediary to hold the funds. You can't touch them. This requires military-level planning, typically starting your search for the next property before you sell the first. But if done properly, it's a game changer for growing your portfolio. So, let's get it all back home. Your main takeaways are as follows. First, passivity is a service you purchase. That 8 to 12% management fee is the cost of freedom. Second, long-term residential rentals are the path to real stability. Third, leverage is powerful, but you've got to have some significant cash in the bank. Don't be over-leveraged. And here's your action plan. If you're new, look into house hacking. It's the lowest risk way in. Then learn the BRRRR method to recycle your capital and grow fast. Always screen tenants. It's cheaper than any eviction. And if you're trading up, start planning your 1031 exchange strategy early. Wealth creation using rental real estate is a marathon, not a sprint. It's simply about making solid, strategic decisions in alignment with your financial freedom objectives. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.